Hello and welcome to the Harwood Report. Today we're doing a special one on Tuesday, November 6th. I'm Keith Harwood, the founder of Trade Academy. Big day today, it's the elections, but first, before we get into the stuff, let's talk about disclosures. All services and content are provided for educational and information purposes only and are not intended as legal or financial advice. Take a moment to read the rest of these disclosures, then we'll get into the charts and commentary. All right. Hopefully that was long enough for you guys there. I'm gonna go through all this stuff as usual. With the big focus for me on what this election means to the markets, because we've got this midterm election tonight. People are out at the voting stations right now, putting in their votes. We're trying to determine whether the House is going to flip from GOP to Democrat and whether the Senate is going to be held. Most people seem to think it's just going to be split. There's an outside chance that one, either the GOP or the Democrats take both. I would say we're probably going to be split, and at the end of the day, it all kind of means nothing. But we have this extreme fear in the market, and some of this has been driven by profit taking into the end of the year, tax loss harvesting, interest rates rising. We got the Fed meeting on Thursday, so that's going to dictate that. But I want to show you guys a few things on these extreme greed metrics because I think this is important. So let's start at the bottom. Extreme fear, but you see that it looks like we're getting a little bit of a turnaround. It's either a dead cat bounce, that's that idea that you just bounce and then fall, or this is the end of that extreme fear metric. This is starting to turn. 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 This is starting to turn back down. This is starting to turn back down. So all these things that are still at extreme levels are getting away from the extreme level without it really impacting the overall fear and greed index. So it's something to watch. We're going to get away from it because naturally, having an election, having the results will take some uncertainty out of the market. So what do we do when that uncertainty is out of the market? We sell volatility. It's what we did on the market, on the floor. We sell volatility when the event and the news is out. You sell volatility when earnings announcements are out. It's done now. So you've got the announcement. You don't have to bid a premium as much anymore. Okay? So dropping volatility tends to lead to bullish price action, which tends to keep us out of it. So let's look at the technicals and see what has to happen to get us into that bullish mode again into the end of the year. Well, right now, we've basically looked like we formed that bottom, right? 260. We've gotten some distance away from that. We're already 5% off the lows. Where's the next target price? I'd be looking for this recent high here in October. What happens if we do that? Well, first off, we're above the 10-day moving average. We're above the 20-day moving average, and getting up there would get us above the 200-day moving average. That puts the long-term bull back in the market. The long-term bull may have stopped out when we cross the 200-day moving average, either here, 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 or here. There was a week where we were just basically sitting at it and consolidating. Do we go in a straight line through the 200-day moving average? Often, no. There's often a little consolidation right at it. So that could create a little bit of like a triangle here where we sit just around the 200-day moving average and then go. But what can get us to go faster? A lot of people say that if the GOP keeps both the House and the Senate, that they will then start pushing through more beneficial elements for the stock market, like capital gains tax reform and things like that. If that happens, then we don't have to stall the 200-day moving average. So if we stay split, we sit around the 200-day moving average before pushing through in a week or so. If it goes to the GOP, I think we push through. And maybe we consolidate here at the 100-day moving average at 281. In that process, vol needs to come down. So either way, I think that we're going to come down. Vol is going to come down either from the consolidation, which puts us down towards 18, maybe 17.5 on cash VIX, or down all the way maybe to 15 on a press to the 100-day moving average. So thinking about all of that, there are ways to play this. The way that I normally structure something like that would be via either a butterfly or call spread at the least. Butterfly if I'm confident on my stall point, call spread if I'm a little less confident on where we may slow down. Because what's going to happen is as I drive towards my short strike, the volatility comes down and that option gets a little cheaper, relatively speaking. If you want to know exactly how I'm looking at that, I want you to sign up for the premium newsletter. It's at Harwood, tradeacademy.com/Harwood Report. Take a look. You get the first week for free. I put up the newsletter yesterday. I talked about how I'm looking at structuring trades in SPY for that vol drop into a rally. And we can go through it with the other indices. Small caps have been destroyed, and look how far away we are from the 200-day moving average. So if the S&P is going to run through the 200-day moving average and towards the 100-day moving average, we got to think IWM has a long way to run here before it really slows down. So yes, it is the most bearish, but also it is the most prone to a short squeeze. And the stall here, the major moving average stall, is $6 away, almost $7 away. So it's 4 or 5% away. That creates a little more leverage here. It creates a little more of an opportunity if the market is going to be bullish coming out of the elections. And in that note, we do have to consider the fact that XLE has been weak, which has been part of the small cap weakness, because small caps have IWM has a lot of financial and energy exposure. So energy is bouncing back. That's got a long way to run before we hit that 200-day stall point. But energies aren't even above the 20-day moving average, and these slopes are all very steeply down right now. So that's a little bit, that's going to see some headwinds, I think. And XLF, the financials, you can see that those have actually started to turn around, and that 10-day moving average actually has a pretty steep upslope here. So that should cross the 20-day moving average, help create a little bit more support here, because a lot of people like to see those shorter-term moving averages above the longer-term moving averages in a bull trend. Let's go to Qs, because that was the source of a lot of the bad earnings, and it was not really all tech. It was just these big boys, the FANGs, the Apple and the Amazon, and those put a big impact on the Qs, but we didn't really explode below the 200-day moving average, and in fact, right now, we're just hanging out between the 10 and the 20 and really close to the 200-day moving average. So it's similar to the S&P in that if we could easily push that 200-day moving average and park ourselves here at the 100-day moving average on just election risk-off behavior coming out of the market. So as that all comes out of the market, I think we're going to continue to see these things run. Let's move to bonds, because this has been part of the story, right? Interest rates rising means there is an alternative. The whole thing that was going through 2017 was there is no alternative. Yield is too low. You have to be in stocks. You can always sell a call against it as a way to create yield, or you can buy stocks that pay dividends as a way to create yield. Well, as TLT falls, that's telling us that bond yields are rising, which we're all aware of. We're exiting that quantitative easing process. And basically so often we just get another little leg lower as long as the economy is doing well. So if the economy starts to struggle, what is the Fed going to do? They're going to slow down their rate hikes, and then that creates a bounce in TLT. Eventually. Right now, this is telling us that really the economy is not bad enough to slow down rate hikes. That's fine for the stock market. It doesn't really put a huge headwind to the stock market if the economy is doing well. Obviously, if things like the China trade tensions get diffused, that's going to be even better for the economy. But we're not going to see this rally. If we're not going to see this rally, then it tells me that the bond traders in the world aren't that worried about this being a global market collapse or even a domestic market collapse. We're not going to, so the bond market is telling us not to be as scared as the stock market is. And we saw that again in February. I mean, the thing, we fell, and then we just sat here while the market tried to recover out of it. And then, yes, we had a little bit of a bond rally. So I think that we'll probably see a little bit of a bond rally along with a stock rally, because people will probably start kind of doubling into that trade, the risk parity trade. Especially if now they've done all of their selling for the year. If we've done all that tax loss selling and that is completed, then that just creates a little bit of a slow rally into the holidays when things are boring and the VIX is dropping. And it can rally both. So we'll see how that plays out. This is a lower conviction for me overall. I'm looking at TLT more as a signal than a trade. So let's go to the gold market. So first I'll actually start with the dollar index. You can see that the dollar index had a little bit of a pullback from highs, but it's really not falling at all. Dollar yen, you guys know I love dollar yen as an indicator, and that is continuing to firm. And it looks like it was just basically a little pullback and now resuming the uptrend. So that's bearish for gold. Sorry, gold bugs. We are in a situation where gold just doesn't have that much value as long as the dollar is strong. Now, resolution of the China trade tensions could have an impact on that because that could weaken the dollar relative to the Chinese yuan. China is a large consumer of gold as well, so if they start increasing their gold imports as they get more confidence, that actually could create a bid to this market. But I think we're looking at a bearish to like 114 kind of trade here, not necessarily new lows, but like down towards 114 in GLD. So, down $20 in gold futures. It's not a huge move, but there's something there. Now, if things start to change in the trend for the dollar, particularly the dollar yen and dollar yuan, then maybe we start looking at that potential for a move to 120. So that's a little bit of a trend change that I have to watch. For now, it's more of a put spread trade, though, because volatility is not that cheap in gold. All right, so then after gold, we've got, of course, silver. Silver had been the lagger. It got a little bit of a bump last week. Looked like maybe it was going to finally participate, and now it's just drifting lower again. So silver's just not exciting. Nobody likes silver unless they're really bullish gold. So that's the thing that I always want to keep in mind with silver is that I get bullish on silver after gold is starting to rally, not before the whole rally. It's like the the OIH to XLE that I'll get into in a moment here. So let's talk about that oil stuff. I started talking XLE. Oil is basically sitting at the lows, doing a little consolidation. It's unclear to me what's going to happen because we're below all these moving averages. It looks a little bit bearish, but can a stock market bull run put money flow back into oil? Can resolution and stuff with China put money back into oil? Can global macro growth make oil look good again? Absolutely. So this can change quickly. And if it does, that's where XLE can shine. XLE, we see, has already bounced some. OIH has not. So OIH is trading much more in line with oil prices, where it's just kind of sitting at the lows. This is something that I think I want to watch for the explosive upside, but knowing that, again, volatility is expensive in this space because we're so close to the lows. So there are ways to trade that again that take advantage of the high volatility for a little bit of a bounce that gets more explosive if and when oil gets back above its 200-day moving average. All right, folks, that is it for today. If you want those trade ideas that kind of mesh with my technical and sort of fundamental analysis on this stuff, you sign up for the Harwood Report. First week is free. After that, it's only $49 a month, and it's going to have specific trade ideas, more content. I do a Wednesday update for subscribers only. So you get basically 3 times the content. Right? You get double the number of videos, and you get all of the actual trade ideas and concepts there and how I actually apply them in various scenarios. So if you're looking for some education on this stuff, I highly urge you to try this out. It is free for a week. That is as cheap as I can do it. I am not going to pay somebody to subscribe to my product. So if you want this, sign up now. tradeacademy.co/Harwood Report, or email me, keith@tradeacademy.co, if you have any comments or questions. Thanks again, folks, and I will talk to you next week.